exports. All right, so we are looking at how a company, right, a business is going to enter a foreign market. Okay, so far we have talked about the various factors that can affect the firm. So let's say, okay, here we looked at globalization, one of the trends. We looked at the different political systems, economic systems, and so on. We looked at economic development, right? Emerging markets. We looked at international trade, right? We talked about comparative advantage, absolute advantage, and so on. Then last week we met once, right? Okay, so we talked about the business strategy, what kind of strategies there are, and then also the structures for the organization. So we haven't talked about how to enter the market, right? So we just took it that, okay, we are entering, and then what factors could affect, and then what can we do to prepare for such entries. So this one here, this chapter is focusing on the ways to enter. Okay, so by and large, of course, we can say that, okay, we're going to sell in a foreign country, right? That is the main goal. But the way to do this can differ, and then they will have their own sets of pros and cons as well. Okay, so these are some of the considerations. So first of all, we talk about this thing called exports. Okay, so exports, I think, is quite straightforward, right? You guys are familiar. So exports is simply just to sell overseas, right? You are not actually, you may not have a presence around there. Okay, may or may not have. All right, but let's say in the technical definition of export, right? We are simply just selling overseas. So we may not be producing in that country, that target market. We may not have any business operations, any offices there. Simply said, we are just producing from where we are and then selling overseas. So, for example, right, let's say you look at the case of Tesla. So we see here the example. So this one, the examples, as much as possible, I have included into the notes itself. All right. So please do remember some of them, and we can use that in the exam, okay? Because again, the exam may ask for real life example. All right, so Tesla, for example, okay, give me a while. Okay, so Tesla here, they export the electric vehicles from factories in US and China to markets like Europe and Australia. All right, so that is the example. Of course, there are many examples, right? But please have something concrete, okay? Please don't say like Singapore, they buy clothes from Thailand, right? That one is still a bit vague, right? We can add more details, what brand, what product, right? So add more specific details. Okay, so first thing is we simply just sell overseas, right? So as you can see here, there are two ways to go about doing your exports. So first one, a company sells the product directly to foreign customers or intermediaries bypassing the third parties. So you have greater control, but require more effort and resources. Now, when you sell directly or when you engage in direct export, right? So we want to reduce the cost here. Okay, so you can see that the main thing here is about bypassing the third parties. So we are trying to save on some costs. The more parties that are involved, right, the more the prices will keep going up, right? So if I go through 5 channels, all right, or if I go through 5 parties, and it's at every round they're going to increase or going to add a markup, right? Because they're doing something and then they want to make some profit. So they're going to do a markup. And eventually when it reaches the end consumers, the price will be so high. So it's going to be not that desirable, not that attractive. So people are not going to buy as much. Okay, and that defeats the purpose of selling overseas. We want to save cost here, and then we don't want to go through so many intermediaries or so many parties. In contrast, let's say with indirect exporting, we say that the company relies on intermediaries. Okay, so the difference is here, mainly here. So then, such as the export management firms or agents to handle the sales process abroad. Essentially, it's whether we need someone to help us with the whole process. If you are able to liaise with your customers, if you are able to liaise with, let's say, the other party over there, right, the one that's going to distribute your items and so on, then that can help you save some money. But in a sense, if we need more help, right? Let's say we're transacting a house. Okay, let's say simply put, right? Let's say I am as an individual. So if I'm transacting a house, right, I don't want to go through the paperwork. I don't want to do the search manually. I don't mind paying for an agent to help me do that. Then I can take that path, right? I can choose the agent. Of course, the agent is going to charge me a fee later on, right? So whatever price that I transact at, whatever price that I buy or sell my house at, they're going to take a commission, right? That will be about 1 to 2% of the overall house price. Okay, that could be quite hefty. But on the other hand, if let's say we are short on resources, let's say we have the expertise, right? We don't mind doing the paperwork. We want to save on the money. We know how to do everything. Then we will go without the agent, right? I will maybe list the house myself. I will go through the paperwork, everything myself, right? Just to save on that maybe $10,000, $20,000. Okay, so in that sense, the difference here is also with the presence or absence of the intermediaries, right? Whether we want to go through the agent, export management firms to handle the whole process for us. Okay, so one is with direct, one is with indirect. So here the difference is quite straightforward, right? It's mainly for this point. So the MCQ could actually ask us, let's say, explain, right, or state the reason, okay, which one is the main difference between direct and indirect exporting. So then in that case, the MCQ will give us four options to choose, right? That will be straightforward. Then if it's for short answer question, they could ask us, give me a while. Okay. So they could ask us explain, right, the difference between direct and indirect exporting. That's one part. Then after that, they ask us to talk about the impact, right? Or let's say, when is this suitable for any type of firm? So that will require a bit more elaboration, explanation. Then we'll need to write more. Okay, so the way that this part can be tested is as such. Unlikely this will come out for essay, all right, because there's not too much information unless it is combined with like everything. So the essay wouldn't come from just export. It will come from like, let's say about entry modes as a whole. Okay, so they can ask you to explain about the different ways a firm can enter a foreign market and to discuss the pros and cons. Right, so that means the whole essay will be based on the entire chapter 6 content. Okay, so roughly that's how the questions can ask. Okay, examples here. So SMEs often use export intermediaries to expand internationally. For example, this firm Joe and Juice, right? They partner with the distributors to sell the health drinks in the US without setting up direct operations, saving costs while still penetrating a competitive market. Now, saving costs here, okay, just to clarify, now we're going to go through an intermediary. So this fact, this alone is going to increase the cost because you are going to hire someone's help and then you're going to pay them because it's not free. So this portion, right, just having the intermediary or let's say the agents is going to add cost. However, if you look at the whole situation, right, if we lack the knowledge, if we lack the skills, the expertise, the familiarity of the foreign market, we don't have time, we don't have the energy to go about, right, looking for everything. You just want someone to handle all the matters, all the tasks for us and to speed up so that we don't like make mistakes, right? Then eventually, right, even if you engage the agent, the intermediary, it could still overall be cheaper. Okay, just to clarify, so hiring the export management firm is going to incur some cost, but if you look at the whole picture, overall the firm could still save cost when we hire them if let's say they are able to save on a lot of time, energy, resources, avoid many mistakes, right? Because the export management firm that you engage, they will have expertise, right? Because you are paying them for the service, you wouldn't expect them to not know anything, right? Or to make those same mistakes that you would be making. So if you can avoid all this, right, save on all these resources, then overall it could still save cost. Okay, so that is why here they say that you could save the cost, right, without having to do it yourself, without the direct operations, and then still being able to penetrate a competitive market. Okay, any issues here you have, you let me know. Okay, so here we talked about what exporting is, right? And then the two main ways of exporting, which is direct and indirect exporting. All right, then we gave the examples as well. Okay, so here we need to also focus on the pros and cons. Okay, also the pros and cons. So advantages, it says that you have minimal investment compared to other modes. So later on we'll look at other modes and see how they work. All right, but for now, minimum investment means that we are going to save on some cost, a lot of cost actually. You are going to save on your time because essentially how you operate in this manner is I produce in my own country or whatever country you're already operating in right now currently, and you sell overseas. Right? So the only way that you engage or interact with the foreign market is to actually just sell to them. right? Which means that you're not setting up there. Your presence there is very minimal. You're not producing there as well. So not producing there, not operating there mainly. So you don't have to spend your time and all that to set up there. Suppose now, right, it is not a very lucrative venture. Suppose you go in and you realize that, hey, it's actually not doing so well and you don't incur as much losses. Let's give an example. Let's say if you guys remember, I think it was some weeks back, right? We talked about the example of Borders. Okay, we talked about the example of Borders. So Borders, back in about 10, 20 years ago, right? It was mainly selling books. Okay, if you guys are not familiar, so it operated as a bookstore. It was at Orchard area, and then they also had the cafe. Okay, so there was a cafe inside the store, right? Quite a nice, cozy area, and then you can see like the cars moving by. And you have, of course, the books. So mostly English books, if I'm not wrong. And then located in a very ideal, optimal location, lah. Okay, so you can attract the crowds, right? So in the first place, they set up here, they spend so much money doing renovation, and then they have to bring in the products, right? And then hire the staff, etc. Okay, and then of course renting the place and so on. So that's already a lot of costs, right? That you may not be able to recover. So eventually, of course, we know, right, by now it has really shut down, right? It has exited the market. So it could also be because of the changes in the way people consume things, right? Like maybe nowadays we don't buy as many books as before. We use ebooks, right? Or we simply just search online because our attention span may be also shorter, right? Like if you were to ask you guys who are already here, right? How long, when was the last time you actually finished a book? Yes, yes, yes.
Sorry, I'm late, sir.
No worries, no worries. You guys who just joined in, remember to type in your name in the chat, okay? I'll help you to do the attendance. No worries.
I'm late. I'm considered late, sir.
No worries, no worries. I'll just help you to do. It's okay, right? No issues. As long as you guys are here.
Okay, thank you.
All right. Okay, so let me continue. Yeah. Okay, so in this case, right, we see that they have a lot of losses. They have a lot of sunk cost, right? They cannot recover. Because eventually no one is buying as many books, right? And the cafe alone cannot support the whole business, right? Even though you're charging like, I don't know, $10 for a bowl of soup, okay? So eventually they have to shut down, right? Versus, let's say, in the situation where I am producing, let's say in Singapore, right? And then instead of setting up a whole store in, let's say, Malaysia, right? I just choose to sell my products. Okay, so we can distribute to a store, let's say like Watson's, right? I sell facial products. So I can sell to Watson's and then see if it sells well. Even if it doesn't, right? I didn't spend the money to set up there. I simply just sold them the products. At most, the products are not sold. I will not go in again, right? I will not sell again because this market, this country is just not for my product. So you minimize your loss. Okay, so that is one benefit of exporting. Then second thing is it's ideal for testing foreign markets before committing more resources. Okay, it's ideal for testing foreign markets. So in that sense, you are able to test without having to commit yourself to spending so much resources. I'll give you an example again, okay? We talk about selling on Amazon, right? I think I mentioned to you guys before. So Amazon here, there is this is a platform where you go for online shopping, right? And those retail sellers, right? Retail, not the buyers, retail sellers like us, right? Let's say if today you want to set up a business selling something on Amazon today, right? You want to list your items, you want to produce your items in China, sell to US consumers, etc. You can actually do that, okay? But the issue here is, if you guys recall, we looked at the Alibaba website previously, right? They always have like a minimum order size. And it could be, let's say, a pair of shoes, right? You could buy for $5, but they require you to buy a minimum 1,000 units, for example. So in one shot, you're spending $5,000, okay? That is still considered as exporting because you are not actually setting up in US, right? So it's still it's still considered as exporting, but you want to minimize your risk further. 50,000 and 5,000, of course, $5,000 is a smaller amount to risk, right? But between 5,000 and 500, of course, I'll go smaller, right? 500 is even better because the lower this capital is, right, to test out, to risk, the more times you have to let you try, right? Because it may not be that, and it's very unlikely that the first time you sell something is going to be profitable, it's going to be a big idea, right? So it will probably fail, and you need to have the opportunity to try many times. So one way that the sellers can do so is they can actually buy, let's say, 5 units from the supplier. Okay, so they tell the supplier, instead of ordering the minimum order quantity, the MOQ, we are not going to get 5,000, 1,000 units from you at the beginning, right? You can charge us at the highest price per unit, right? Let's say if you were to order just 5 units, maybe instead of $5, you charge us $7. It's okay. This one we can make some losses, it's fine. So we are going to sell these 5 units. We are going to test out the demand for them. Okay, so we do up the whole listing and so on, and then you're going to list the products and see if you were to sell, you're going to sell this today, right? If, with the marketing, with the ads, and with just 5 units in your inventory, how well received will it be, right? Is it going to sell very quickly, or is it going to take like ages, right? 5 weeks to sell 5 units. So it's a very small risk because you don't have to actually buy so much or at the beginning. So it's a good thing because it allows you to minimize your risks. So here in the same way, right? Here I'm just giving one example, where you just buy that few units and then you test out whether there's demand. If there is, you can bring in the big bulk to sell. If there isn't, then that 5 units, you can take it as just losses. Right? Eventually, if let's say you manage to finish everything, right? You could recover or you could just break even. But for that, we take it as it's just to test out, right? It's a small amount. It could be 7 units it could be 5 units at $7 each, right? 35. Plus you could do air shipping. Okay, because if you were to ship by sea, you're going to take 1-2 months, right? Because we don't want to spend so long to test out the product. So instead, maybe you ship by air, it could reach in a few days' time, right? And you can start selling very quickly. So just to test out whether it's going to work out. Okay, so in the same way here, generally for exports, right? You could just have a bulk, a batch, sell, see if it's okay. If it's not okay, then never mind, right? But you didn't incur much losses to set up in the first place. Okay, makes sense, huh? Next one. Scalability, they can adjust the export volumes based on the demand. Same thing if you are doing well, if you can sell a lot, sell much more, then of course you can keep selling, right? Like during COVID, right? When everyone was stuck at home and then people were just doing online shopping, right? At that time, the demand for e-commerce products, it was just booming. Okay, and then it was just selling a lot. Even though subsequently there were bottlenecks at the ports, right? And then it couldn't deliver over very quickly because of lockdown measures, and then the ports were just like congested and so on. Okay, yes, question.
When people order online due to COVID-19 pandemic, these products are delivered to the customers.
Again, sorry, sir, when they order online during pandemic, was it delivered to customers?
Yes, when they deliver to the customers.
Were they, right? Is that your question? Were they?
Yeah.
Oh, okay, can. Thank you. Okay. There definitely would have been some like missing items, but mostly I would say maybe above 90% it would have been delivered just with a bit of delay. Personally, I didn't order a lot during that period. I bought some items, right? I bought a phone, a laptop, right? It's a big purchase. But it was mostly from the local stores, the local sellers. So the congestion didn't affect me that much because they're already in Singapore. But I had other friends, they were complaining about like delays. At that time, it was because there were the lockdown measures, right? So you couldn't have full capacity of workers, and then people were still like working at 50% and so on. And at the same time, you do the swab test and all that, and then everyone's buying. So all the ships, containers, they were all already like queuing up at the ports. So that led to the delay itself. Yeah, so there were delays subsequently. Okay, answer your question, huh? So let me come back. Okay, so here we have challenges of exporting. Okay, this one on tariffs and trade barriers. This one, I think you guys are familiar with this already. We have talked about this quite a lot of times, right? So the US-China trade war again, it would affect the exporting because it is targeted at exporting. Let's say from US perspective, when China wants to export to US, it was going to the Chinese firms, the Chinese manufacturers would have to pay the tariffs. Okay, because when you want to sell to us, right, this action is going to incur some additional cost or the duties. So the problem here is, right, it is not one-off. Every time you sell, you will incur the cost. And every time the more you sell, the more cost is going to incur. It's good for let's say for US, right? It's good because they will receive a lot of the tax revenue. But for Chinese firms, it is not good because they are not going to make more profits, or they're going to have less profits, right? Because selling to US, you have to charge a higher price because now you have to pay the taxes. If you don't, then you have to eat into your profits. But if you do increase your prices, then the US consumers may not be buying as much. All right, because it's a higher price. And of course, here, if you talk about the perspective of protectionism, right, that we did previously, right, I think it was chapter 4, right? Chapter 4, we talk about protectionism. So from the perspective of protectionism, the tariffs were meant to discourage imports and to encourage local production, right? So then now if you are selling from overseas, it is being frowned upon. It is being discouraged by that target country. So the government is trying to tell you to sell less to us. So here the challenge is you're not going to sell as much because you are not operating there, right? The problem is, or the issue is, if you're already there, you are setting up there, then you are not subjected to the tariffs because the people are just buying from the local firms to them, right? It could be a foreign brand, but it is already in that country. You're not paying the exports. But every time you are selling from overseas, then you are subjected to the tariffs. Okay, so over the long term, if the tariffs are an issue, all right, or if they are a consideration, it could actually make it less profitable. Then lower control, because companies have limited say over how products are marketed or priced. So just now we talked about indirect exporting, right? We say that you go through the intermediary over here, okay? The export intermediaries, or we call this like the export management firms or agents, right? So you go through that party who's going to do your distribution, who's going to do your marketing and so on. So that means it is outside of the firm's hand, right? You are not directly doing it. You have less control. Again, this one, I would say it could be good and bad, right? It could be good and bad. If from the perspective of control, of course, you don't have, right? So it's bad. But in the other perspective, you are actually not doing as much, right? So you can actually free up your resources. So if you're not the one doing the marketing, the pricing, the distribution, you technically can go into different markets at the same time because you are not focusing on one, using your resources on developing that country. But here, this one just as a point. Okay, so please do remember the points on advantages and challenges. If you can, have your own examples, okay? Here I didn't include, because I was just explaining to you guys, right, verbally. So if you remember, right, you can take it down. If you didn't, then maybe you use your own examples or you come up with something that is real, Please don't make up some fake stories, okay? So have some real examples and then use that in your answer. No issues, then we go on to the contractual entry modes. Okay, so contractual here, it's a broader term, right? I would say it's broader than exporting. So export is mainly just selling overseas, right? So when we talk about direct and indirect exporting, there were still types of exporting. Here, when we talk about contractual, that means you sign a contract, right? And then you enter the other country. So this is a broader umbrella term. You will include things like licensing, franchising, and so on. Okay, so you are entering into an agreement with an existing firm. You are not, okay, so you are not actually doing your own brand in that sense. Okay, you are selling their products. All right, let's say in the case of licensing, okay, so a company permits a foreign firm, right? They call this the licensor and the licensee. If you find it confusing, just explain it this way, right? So a company permits a foreign firm to manufacture and sell the products in exchange for a fee or royalty. Okay, so it is an attractive firm for firms seeking market expansion without heavy investment. So the investment here, right, it comes from doing your own marketing, building up your own brand, right? So all this is already done up for you because that firm, that brand is already established. So we give the example of Coca-Cola. So Coca-Cola here, they license the brand to local bottling companies worldwide. Then in India, Coca-Cola licenses the local firms to produce and distribute the beverages, reducing the need for direct investment while benefiting from the local expertise, right? So here you can see, okay, let me just highlight here, right? This one. Okay, so they license the local firms, you produce the drink, you distribute the drinks for us. We don't actually need to come in, right? Or it doesn't have to have a presence in every country itself. Okay, yes, question.
Is business license required to open the business, sir?
Again, sorry.
Is is business license required to open the business, sir?
Business license required to open the business. That's your question, right?
Yeah.
Okay, can. All right, thank you. Okay, so this one just to clarify, in case I didn't mention. So the licensing here, okay, the license not a license to set up your company, but more like to use that company's brand. So like let's say today, for example, right, I want to start my own brand and so on. Then I just need to register with the any organization. Let's say in Singapore's case, we call this the ACRA. Okay, so we need to actually set up, register the company, and then we start operating as a company, right? So that is registration. But here in this context, the licensing is more like because I want to use Coca-Cola's brand, I want to distribute their products, so I have to get into an agreement with Coca-Cola. Okay, so the name is licensing, but in that sense, we just think of it as agreement lah. Okay, it doesn't have to be license. Okay, in case I wasn't clear, huh? All right, so let me continue. Okay, so what was I saying? Okay, so I want to tap into the branding of, let's say, Coca-Cola. I want to sell this product, right, to people who are already familiar. So if I were to build my brand myself, that's possible, but people may not know. So it takes time to build up the awareness, to market, right? Spend so much on marketing. Whereas right now, if I just tell you about Coca-Cola, probably all of you already know this product, right? And probably you have consumed this recently. So to sell it to you is much easier, right? I don't need to convince you, right? When you need it, you will come get it. So then to use their brand, to use their product, we enter into the agreement and then we can actually sell it. But how it works here is, right? Let's say we give the example, they talk about India, right? So Indian firms, their strength lies in familiarity with the local rules, regulations, the market itself, how people operate, the culture, etc. Because the people operating are probably locals there themselves. So Coca-Cola, when they want to enter into a foreign market, then they can enter into this licensing agreement. So from Coca-Cola's perspective, they could tell them, okay, these are the things that you have to take note of, right? These are the things we need you to do, blah, blah, blah. And then the firm is going to do it on their end. Then the firms will make the money because they are selling a product that people are familiar with. They could pay a royalty, which is like every year we could pay you, let's say $100,000, $200,000. Or we could give you some commissions of the sales. Out of all the sales or less profits or revenue, we will give you 5%. And then on top of that, we could pay you the yearly fee, the royalty, so like $100,000 for the use of your brand and so on. So on Coca-Cola's end, it is sort of like quite passive because you are not the one really doing it. You are not getting people, your employees to do it and still feeling very lost because it's a market that you're not familiar with. On the other hand, right, from the Indian firm's perspective, they make money and they can sell something that requires less marketing. The brand is already well known. So it's a win-win situation. So Coca-Cola is able to enter that foreign market in this way. And we wouldn't call this exporting because you are not just directly selling, you are going through this local firm, right? And this local firm is sort of like your distributor. Okay, and in exchange, they pay you the fees and so on, right? If you want to ask about the difference between this and also like indirect exporting, direct exporting, because both go through a third party, right? Indirect exporting, the firm is the one paying that agent, right, to sell the products. Okay. Whereas here, that person getting the license is the one paying you. So Coca-Cola is entering the foreign market and getting paid at the same time. All right, there's one difference. Okay, so this one just to clarify, in case you're wondering, both look similar, right? Still some difference over there, right, in the way that it works. Okay, then franchising is another way that you can go about. Franchising may be more commonly heard, right? I would say maybe you've heard of this before compared to licensing. Okay, so franchising, you allow a business the right to operate under the brand and business model in exchange for fees. So here, licensing is that they are going to manufacture and sell your products. All right. Franchising is that they are setting up there. You see the word operates, right? They are setting up there and then they are going to do the business on a daily basis in your name. So I would say it's even more heavier involvement compared to licensing. So exporting is just okay. I hire you, help me do all this, blah blah blah, finish. Licensing is that okay, we enter into an agreement, you pay me, I will show you like okay, all these things, and then after that, I'm going to help you to show you the ropes, right? And then you're going to sell for me, distribute for me. So franchising, on the other hand, is that they are going to get your brand. I give you the example of McDonald's, okay? Because McDonald's worldwide operates very heavily on franchising model, okay? The US people are not coming to every country to set up, right? So how it works is McDonald's has a training program, right, for the firms that want to do franchising. If I'm not wrong, right, because this example I read a few years back, at that time, you have to pay about $100,000, right, USD, just to get the franchising contract. 100,000, to set up that store over there. So of course we are familiar with McDonald's, right? And we hardly hear of any branch that is not doing well. Okay, if you set up McDonald's practically anywhere, people will come because they know the product, they know the quality is quite standardized, and the pricing is okay. If you want just a quick meal, you don't know what to eat in that area, if I tell you there's a McDonald's, you will just go, right? Because it's very easy. So people are attracted to this brand. So now, if I want to get the McDonald's franchise, I will approach them. Once it's all okay, sorted out, they will owner or the person signing the contract, right? Let's say I want to get the license or don't say license. I want to get the franchising contract. I'm going to approach them, and then once it's all settled, I will go through training. Okay, so as sort of like the owner to be, I will be undergoing training. So they will teach me on how the products are produced, right? The frying, the preparation of food, and then I'll be at the counter, right, taking orders. I will be looking at the kiosk, and then the maintenance of the whole outlet, right? The maintain cleanliness, crowd control, for example, and then arrangement of your seats, how much spacing, all that. So you need to know everything, right? The whole operations, because you are the one who is going to be in charge. All right. So now you undergo the whole training as if you are coming in to be a worker, but technically you're learning the ropes. You have to know everything. Okay. Then once you undergo that training, which is about 9 months, okay, it's very intense, 9 months, then you are ready. They could assess you, like they give you a test, right? Sort of to assess whether you are ready. Once you're ready, you can go and set up. Then later on, there'll be people coming to check on you just to make sure everything is still okay, right? So it's a long process. The profits could be very high. It could be very lucrative. It's an option lah. Okay, essentially it's an option, right? But if you feel like, wow, 9 months, technically you are going to work there, okay? And I'm not sure if you're getting paid. Probably not. You are even paying them, okay? Because that's part of the contract, right? So you're here to learn the ropes and learn everything about it. So you have to be familiar, like, because any problem comes up, right? You are the one they go to, right? Hey, today the supplier didn't order didn't deliver the food. So what are we gonna do? Oh, just now the fryer just broke down, right? We have only one left. What are we gonna do? Or let's say, oh, today is National Day in Singapore, right? Everyone is public holiday, everyone is coming, right? It's so crowded and the aircon broke down. What are you going to do? So all these problems very well could happen, right? And you need to be aware and you need to know how to solve. So these are the challenges, I would say, with franchising, right? But then again, there's no need to build up a brand, right? You don't have to persuade people, hey, buy my product, right? Hey, this is what I sell. No need, right? Just like McDonald's, you already can know the menu, right? You probably may eat McDonald's later. So in that sense, we will this is an option lah, okay, for those who are interested in entering. And from McDonald's perspective, they could want to come into different markets. So again, if I'm not wrong, worldwide, right, McDonald's franchise percentage is about 90 to 95%. So they want to raise this even more. They want to have more franchise outlets around the world to set up. Okay, because this is a way to enter the foreign market, right? And also at the same time, it's quite passive if you realize, because they can actually earn the royalties. I'm not sure if they have also the commissions component, because um, may or may not need, right? But the royalty is definitely, so like 100,000, it could be every year as well. So just that alone is going to make a lot of money for the company, right, without you having to operate yourself. So they are more like teaching the other people how to do it, and then regularly going to check on all these outlets also. Okay, so these are some of the issues going on. Give me a while. Let me see if there's any questions so far. Okay, no issues so far. Okay, let me proceed. So here we can see, right, operates of over 80%. Okay, this one can go and check. Okay, may not be the latest figures. I read somewhere the aim was to hit 95%. All right, so that could be the target. Okay, in countries like Saudi Arabia, they rely on franchising to expand rapidly without owning and operating every outlet. Okay, so you want to be, in a sense, asset free, right? Because those stores, right, are not operated, not owned by the main company itself, right? Because you get the contract, right? So that person who is signing the contract to get your franchise is owning. So they will get the profits, they will operate the store, but they will, of course, pay the fees, right? So it's much more asset light, which is, of course, like generally the trend nowadays, right? If you contrast, like, let's say, hotels versus Airbnb, right? Hotels, they own the assets, they have to spend money to build the rooms, the furnitures, etc. They spend so much money. Whereas for Airbnb, it's very asset light. It doesn't have to own all this, right? It's more like the medium, the channel where the ones who want to rent out, do we call it rent out? Yeah, or who want to lease their apartments, and those who need a place to stay, right, they can come and connect on Airbnb. And Airbnb is doing well, right? It's worth so much, and it is very asset-light. Okay, so in that sense, this could be an advantage of the franchising. So we look at the case with contractual entry. So it's low capital investment. Companies can expand internationally without committing significant resources. Again, this one here is relative, it's subjective. Okay, it depends on the specific way that we go about doing it, right? So we list as a generic point here, but in the question, when they ask, right, if there is a specific context, or let's say when they ask us to compare contrast between contractual and exporting, then you may want to say which one is actually using up less resources, or which one allows us to commit less resources. Okay, so it's subjective, all right? In this case, let's say from the perspective of McDonald's, right? It wants to go overseas. It doesn't want to operate itself or own the outlets itself. It can do franchising. Then it can actually commit less resources, right? In fact, it's collecting more resources because it's collecting the royalties, and then people come and do for free, right? They work at the store for free and they pay you to do so. And after that, right, they go and operate. If they do very well, right, you also earn more because you get the commissions, right, a part or a portion of the revenue, right? So it's a win-win situation. Rapid market penetration, it allows them to scale quickly through the local partners. Now, scaling here is very possible because you don't have to do much research yourself, and then to do that, to enter the market, right? The firms can actually get this potential people to come in and sign the contract. And if they are keen, right, we tap into their expertise, they can all do it at the same time. So in the if you contrast, like, let's say McDonald's trying to enter the China market, they have to do research, come up with something new, etc., before they go in. That is like spending more time and doing just one, right? But if we get people to come in and sign franchise or licensing, then they already are familiar with the local markets. That's one. Second of all, they pay you as well, right? And they can all do concurrently at the same time. So you're able to branch out, to scale up much faster if you were to do it alone. Okay, so it's very attractive, right? Maybe after this, you are thinking, oh, maybe you can sell your business and let people franchise, right? And then you can do less of the work. That's possible. Okay, so local partners will bear much of the operational risk. So technically, they have paid you the royalty, right? The main McDonald's company is not liable for the losses. If let's say in Singapore, for example, they come in here, they get the franchise, they come in here, they set up, and let's say you set up at this location that is really, really very like there's no one staying here, no one coming here, and the business is just so poor that you become like one of the only few outlets that really shut down. That is your situation, right? The main McDonald's in US is not going to come in and say, oh, here is our compensation for you. Don't have, right? You bear the losses, and that's just the case. So from McDonald's perspective, they reduce their risk. Okay, yes, question.
Do the company, where is it? Do the company expand to overseas?
Do the companies expand overseas?
Yes, that's what.
It will allow McDonald's to go into different markets. So that's why we can see McDonald's in like almost every country. Almost. Okay. I'm not sure where they don't operate, but anywhere that I go, right, I probably will see McDonald's, right? At least based on the countries that I've been to, right? I can see McDonald's easily. So it allows them to go into the foreign markets, other countries, and at lower risk as well. Okay, so moving on, huh? Okay, next one. Quality control becomes an issue. So ensuring consistency is difficult. Okay, this one here can have, it can come in different forms, right? In terms of quality control. First one is that the more outlets you have, right, the more likely that some issues could just occur. And to maintain the quality consistent across everywhere is going to be difficult because there are so many. It's like if I have just one store, I can supervise this much more closely. The quality would be higher, right? Quality is one thing. If I have a few stores, like 2 to 3 stores, to check on the quality and now the consistency, right? Making sure that the stores are all like same high level of standard, it's also quite relatively easier. But to have thousands, millions of stores in the whole world, to ensure the quality is high throughout, it becomes a challenge. All right, so that's one thing. Second thing is that the people doing it, there are more of them, right? And it comes from even more different backgrounds. So you're from different cultures, different age group, different demographics. It's like essentially everyone, every background of person you know, right? That could be someone working at McDonald's. So it's very hard to make sure that your level is really high throughout. And also because it's owned by different people, right? They sign the franchising contract, they own it, or they are the ones operating it. So now, if you want to check everyone, it's going to be impossible, right? You just have to trust that no major issues will occur, no major adverse events are going to affect the branding of the company. So that could be one situation. The second thing, the loss of intellectual property. There could be a misuse of your patents or trademarks. So essentially, with the licensing and the franchise, why is it costing so high, right? Why do the people have to pay $100,000 to get the McDonald's franchise? Because you are getting into their recipe. You are operating the McDonald's store. You know their recipe. You know everything. Today, if you get the license, you set up, and then maybe 5 years later you close down. All the knowledge is with you. You know the ins and outs of McDonald's, right? Can they really prevent you from using the recipe, modifying it, and then selling something similar but not the same, right, under a different brand? I can let's say in Singapore's case, right, we have heard of people, right, like the chefs in the Michelin restaurants or like the high quality restaurants in Singapore. They were former chefs. They work there, they cook there, they know the recipe, and they go and they leave the company, right? And they set up their own stalls, let's say in the coffee shops, in the hawker centers, and they sell such products, right? And it made the news. Okay, like Michelin star restaurant chef, right, comes out and sells at the hawker center, and they sell similar dish, right? Over there in the restaurant, they charge you $50 for the pasta. But you come to hawker center, right, for very similar taste, they charge you $10, right? Because, I mean, no one's going to buy a noodle or pasta for $50 at hawker center, right? $8, $10 is already considered a high price. So in that sense, right, you could take the, yeah, okay, yeah, okay. Thanks for the example. See, so you can actually take their ideas, their recipes, their inventions, their products, modify it, and then reproduce as your own. So there is always this thing here, and you cannot say no, right? Because they pay you $100,000 and they were going to use your brand. You cannot say, oh, because you are not, you don't belong to us, so we are not going to tell you how to create that McSpicy. And it cannot be the case where all the other outlets outside US, they don't sell McSpicy, they don't sell Big Mac, they don't sell all the burgers because it's a recipe that should be guarded. And then there's no McDonald brand already, right? So you have to share all this, and that means revealing your secrets. So in exchange for that high price. So again, it's whether you want to share this, whether you feel comfortable sharing. And then if you do, then you can charge a higher price. If you don't, then probably this way of entering the foreign market may not be suitable for that company itself. So these are what we have now. Again, the question could test, okay, I'm just giving some ideas. So the questions could test on the pros and cons as well. The question could also ask us to suggest possible ways to enter the market. So these are the common ways to ask, right? So explain what the methods are, the pros and cons, compare contrast between the methods, and then also they could ask you to suggest possible entryways. So the context could be they give you a short scenario. This firm is now selling clothes. It's operating where, how much capital they have, and then based on this situation, suggest some possible ways for them to enter the foreign market. So then we are supposed to explain the ways, maybe two of them, and then after that talk about the pros and cons. So in that sense, it will be more of an essay because you have so much to write and to discuss and to give your opinions, and then after that you can give your suggestions, right? So okay, method A and B are possible ways, but in my own opinion, after looking at the pros and cons of A and B, this is my suggestion. I will suggest that you choose A because blah, 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 right? This is your conditions. Then I will say A is better for you or B is better for you, right? Based on this firm's conditions. So this one quite important, quite a lot to test as well. So please do be familiar with the content here. Okay, so we talked about contractual mode, contractual entry mode. We talk about exporting. Then the other one, the next one will be in terms of the investment entry. Okay, so okay, show you the example first. So we have here a joint venture, a partnership between two or more companies to share ownership and control of a business in a foreign market. Okay, so this one allows them to share risks and leverage the local knowledge. All right, so you have the example here. You can take a look. I share with you another example outside the notes. All right, in the case of Singapore, few years ago, Singapore's central bank, MAS, Monetary Authority of Singapore, so they actually invited firms, right, to submit their applications to open up a digital bank. Traditional bank we are familiar with, right? You go to the branch, you open a bank account, they provide the banking services physically, right? There's an outlet. With a digital bank, it's just online. There is no store per se, right? Any issues you have, you can go online to chat with the live assistant. You can call up, right? But mainly everything's online. So that's the idea of a digital bank. So they want to open up the banking market. So amongst them, there was this pair of company, right? It was Grab and Singtel. So Singtel is a telecommunication company in Singapore. Grab operates in Singapore as well. I think you guys should be familiar with this. So you can call on your phone and you can get a ride, right, to anywhere. So these two companies are not in the banking sector. One is a telecoms company. One is how should we define this? So Grab offers food delivery, right? It offers the ride-hailing services. So it's sort of like, it covers a lot of things, okay, to say it's a bit like Alibaba or like etc. So in that sense, they are not the traditional banking sector, and then they want to come into the banking sector, right? So for them, this joint venture would be good because they can share the risk. They are not that familiar with the sector. So when you come in, you pool your resources, you split the risks, right? So it's a win-win situation. And now they have already set up, right? It's called the GXS Bank. You guys can Google, right? Or you can Google Singtel Grab Bank. it will show you, right, the GXS, and it's operating in other countries like Malaysia as well. Okay, so that is an example of a joint venture. So the good is, of course, you pool your resources, you share the risk. The bad is that it could actually, so your ownership will become more limited because it's not just one firm that's handling everything or taking charge of everything. It's actually the two firms. So they could have different ideas. They could not agree on something, right? Then that could come to a standstill in terms of the decision making. Okay, but by and large, of course, this is an option for the firms to consider. Another one is a wholly owned subsidiary. A company establish a fully owned foreign subsidiary, giving it complete control over operations, branding, strategy. The mode requires significant financial investment, best suited for companies with long-term commitments to a market. All right, so second option here in terms of the investment mode, this is a wholly owned subsidiary. Okay, so let me just highlight the key portion here. So they have fully owned foreign subsidiary, complete control over operations, branding, and strategy. Okay, the example. Apple has wholly owned subsidiaries in various countries like India. They have invested heavily in production facilities to meet the growing demands, avoiding the import tariffs. Okay, so first of all, right, you can see that this is one advantage over exports, okay? Because there is no need to pay the tariff. So there's no need to pay the tariff. We are already operating there, right? So it is able to bypass the tariff. So it's an advantage over exporting. Okay, so that's one. And the other thing here is that it belongs to you, right? The subsidiary is another firm, okay? It's another firm. So let's say Apple, right? They want to set up in Singapore. They could call this SG Apple, for example. Okay, so this brand operates under, it belongs to Apple, right? It's just a different brand. SG Apple will have its own control, right, over how things work in Singapore in terms of the distribution, the strategies, etc. So good and bad, right? Good is that of course, it's able to go into the market, and then you can have control by the firm itself. And also at the same time, you probably will have access to the local experts. If I were to set up SG Apple in Singapore, of course, probably would be hiring the locals, right? They are familiar with how things work, the rules and regulations, and so on. So you're tapping into those and keeping full control, because unlike licensing and franchising, where you allow someone else, a third party, right, to use your brand for anything, it is not going to give you full control, right? But here you still have, because that subsidiary belongs to the main company. However, on the con side, it is going to require significant financial investment, because you are going to set up overseas, right? Just using another name. So there will be costs like the rental, wages, etc. Okay, you may need to renovate, you need to get an office, buy a building, whatever. So all these are going to be more cost compared to franchising, compared to exporting. All right, so that is another way to go about. But of course, here it could be suitable, right? In terms of the appropriateness, it could be suitable if you are very committed to this market in the long term. Okay, so if we export, right, then the con is that every time you may be subjected to the tariffs. That's one. If you do licensing and franchising, then the cons here would be that you lose control. And even if they do very well, they will be paying you the fixed royalty. So that is guaranteed. But the proportion or that fraction of the revenue or profits that you get will be very small, because they already pay you the royalty, right? Which is a flat fee, and it's quite high, right? Six figures, $200,000. So they wouldn't be paying you 50% of the profits, right? Then it makes it very difficult for them to earn money. So they are not going to sign the contract in the first place. So it probably will be just 3 to 5%. Okay, 3 to 5%. So that means if it does very well, if the market is very lucrative, you are not getting the majority of the gains. You're just getting a small part, right? If you feel that it is a market that you are very committed to, there is strong potential, then in terms of the WOS, right, it could actually give you much more profits potentially, because you are the one owning, even though it's a subsidiary, right? You are the one owning. So the profits will still come back to the main company. And with that, you split the cost, because your resources you have built a factory here, you have your offices here. So over time, you save on the tariffs. You could tap on the expertise of these people you hire, right? You could spread your costs over these resources, and that makes it cheaper in the long run. Okay, so just to stress, so WOS here, wholly owned subsidiary, it could be very lucrative, right? But it's more towards the long term. Okay, because in the short term, or if you are not transacting high volume, right, or if the market is not promising, then when you point so much resources, you may not recover them. So the firm has to be very clear that this is something they want to pursue before they actually enter into this market. Right? So that is a main consideration. Okay, so first one here, advantage of the investment mode. Companies have complete authority over the operations because it belongs to the company. It still belongs to them. All right, it's just another name, but it belongs to them. So it could be like, let's say, UOB, the United Overseas Bank, a traditional bank in Singapore. So when they set up overseas, like they have UOB in Malaysia, for example, Malaysia's directors, Malaysia's person in charge, right, will be handling the Malaysian operations, but ultimately this still belongs to the main UOB bank. So in that sense, you are not losing control of the bank itself. Okay, so that is one. Okay, give me a one. Okay, sorry. All right, so then coming back. So profit retention, you don't have to share with the local partners, but you can retain the profits. Okay, this one we mentioned, but again, this one, the question is how much the profit is, right? And to compare the profit against your cost. Okay, so if the profit is not extremely high, right, or if it doesn't justify the high cost, then doing it this way, right, the investment entry mode may not be suitable at all. Okay, so they have to work out the finances and see whether this is a viable option. Then last part, investment signal long-term commitment, enhance the brand strength in the local market. So like the case with Dyson, I may have mentioned previously, Dyson changed the headquarters to Singapore a few years ago. So it's a signal that they want to really focus on the Asian market or even the Southeast Asian market. And they may be using Singapore as a gateway, right, to the local countries. That's one. It's also signaling that it sees potential in Singapore, right? Because not only are we interested in the neighboring countries, we are also interested in the Singapore market. We trust in the labor, right, the talents. We trust that the consumers here will also be buying from us. So this is a signal, right? This is a signal to all these parties. Okay, however, as we said as well, there is substantial capital investment. Okay, so you're going to spend more, right, compared to, let's say, the other two ways, right? Compared to licensing and franchising, the firm is not spending, they are getting money instead. Exporting, you're just selling your goods overseas, right? You're not setting up presence in that firm. So in those cases, you are minimizing your resources compared to this way where you are setting up and then you are pouring in so much resources. Okay, so there is one, right? Second point here, there is exposure to the local economic or political instability. Now, this one is, we can think of it as a yes and no. That means, are you exposed or are you not exposed, right? The other way to think about it is on a spectrum, right? How much exposure do we have? Technically, if you look at export and franchising, right? Can we say that even though we don't operate there, we are not exposed to their economic situation, their political instability? I would say not really. Even if, let's say, McDonald's situation, okay? Let's say if they do franchising, right? And the main company doesn't operate the outlets around the world. Let's say when there is a virus outbreak, right, in one country, a foreign country, can we say that McDonald's wouldn't be affected? To some extent, yes, because there will be fewer people coming up to sign the franchise agreements. The existing firm's profits will also suffer, and with that, McDonald's main company, right, will also receive less commissions because the commissions are based on the profits. Right? So to some extent, you would still be vulnerable. It's just a matter of how much. Of course, here that 5%, right, wouldn't matter as much compared to the royalty fee that you receive, wouldn't be significant compared to their own operations in US. Right? So you have minimized that compared to, let's say Apple. Okay, let's say UOB, right? UOB sets up presence in Malaysia. So they have branches, they have offices, right? It's just that the main headquarters is in Singapore. So if the Malaysian situation is very negative, like the economy collapses, or let's say the political party runs into some problems, right, etc., etc., the impact, of course, will be much greater on UOB, right, compared to if it's just franchising, compared to if it's just, let's say, doing a licensing or just exporting. Okay, so the exposure here may not be in terms of have or don't have. It could be in terms of how much, right? To what extent. Okay, so for investment mode, it is very high. And definitely, yes, there is exposure. So do we want to be exposed to that or not? Then second thing, setting up could be very time consuming compared to other entry modes, right? As we mentioned just now, when we talk about franchising can be very fast. So you can have multiple candidates from different countries, right, undergoing training and then setting up all at the same time. So at the same time, you could be opening up to 5 new markets. Whereas if you want to set up in another country by yourself, it will take more time because you have to be familiar with how they work. You have to choose a appropriate location. You have to do everything. So now you have to prepare everything before you set up. So that's going to spend more time. It's going to be slower. Okay, so we have talked about all these different methods to enter that foreign market. Just to sum up, you can export. Export we split into direct and indirect. You can choose to do licensing and franchising. That means you give someone else, a third party, the rights to operate your brand or to sell and manufacture for you in exchange for a fee that you receive. If you invest, right, then you will have to set up yourself, whether on your own, let's say UOB sets up on its own, or in the case of Grab and Singtel, they can do a joint venture and they set up a new company together. So that whether you want to use more resources or not, right, that's your consideration. So all these points, please be familiar with the different ways, how they work. Please be able to provide examples, okay, because the exams will ask for examples. Please be able to provide the pros and cons, the advantages and the challenges, because they will require all this as well. Okay, then the last part, they could ask you to select the appropriate way for the business, right? The question may give some conditions, some background information about the company, or they could just give you something very brief. All right, so the last part, yes, okay. So section 5 here, we look at the strategic factors in selecting your entry mode, right? So based on all this, how are we going to select the appropriate way to enter the foreign market? Okay, so first one, we look at the case with the market size and the growth potential. Okay, the market size and the growth potential. So that's your first one. So the point here is, if you are looking at these markets, right, they gave the examples of China and India, it will justify the higher levels of investment. Okay, so then we can choose the joint ventures and also the wholly owned subsidiaries. All right, so this would be the first way to explain. Now, how you actually define or how do you actually calculate the market size and growth potential? That is very subjective, right? You could look at existing firms. Okay, so one way is we look at the data of how the existing firms are already making. In terms of the largest players, what is their revenue? What is their, let's say, how much profits are they making, right? And then as a whole, the whole industry, how much is it making? Is it increasing or is it declining? Right? Let's say if you look at the bubble tea market. Okay, so let's say now if we picture the bubble tea market, right? You have many new firms coming in all the time. Okay, so in the beginning, in the early 2000s, right, 20 years ago, we had like Sweet Talk. Right? You may not even have heard of this. Until recently, right, you have the Chagee or the Chagee, Chagee. So that is one of the latest firms to enter Singapore, right? They set up a branch at Plaza Singapura. I think we talked about this previously. So in that case, you have all these firms, right? You can look at all the firms, the whole industry, right? Is the revenue stagnant or constant? Okay, see how you describe it, right? Is it consistent? Is it increasing trend? Is it declining trend? Then also at the same time, you look at the top few firms, right? How much are they making? So if these firms are coming in and then they are making more, and you see there are always new firms coming in and making very high levels of profits, right? Let's say for bubble tea, then you could actually see an opportunity there, right? Like in Charge's case, okay? So they decide to come in and set up a branch here. So it is not just exporting. They didn't sell their drinks through 7-Eleven or any supermarkets, right? Instead, they set up a physical store over here. So then it requires a heavier involvement, and they see that the market could be very profitable. Okay, so like in Singapore's case, right, people like this beverage. The income level, they are able to afford these beverages. They always drink, right, on a frequent basis. And if you make it very attractive, if you make it visually appealing, they could actually post on social media, right? Like in the case of Chargy, when they open up, right, they attracted a lot of people to post on TikTok, Instagram. People were just posting, oh, I bought a drink here, I queue up here, oh, managed to take a photo in front of the store, etc. Because very visually appealing. Instead of, let's say, if you remember Sweet Talk. Okay, like let's say Sweet Talk. Okay, not sure if you guys know about Sweet Talk. Okay, let me see if I can find. Give me a while. Sweet. Okay, so nothing insulting or anything. Okay, just for our discussions. So if you see here, right, this is, if you can see on my screen, yeah, roughly. Okay, you can see. So this is the firm that came in early 2000s. Okay, and then it has been around for 20 years already. The popularity may be declining, right? Maybe if you guys haven't heard of it, you don't drink it, etc. And also in terms of the visual appeal, right? If you look at this store, could you consider taking Instagram stories, Instagram posts? Probably wouldn't, right? So this is one consideration. Then if you look at the case with Chaji, right, you can see that it's already visually appealing. So the drinks here, they have very nice packaging. Even the bag is very nice, I can tell you. Okay, if you bought from here, right, the paper bag is nice. I think they have also got the something like a tote bag, right? Something like a tote bag. So this can be reusable. Not this, but the tote bag can be reusable. Okay, not not this, this one Christian Dior, right? But something like that. And you can see the branch. They make it very visually appealing and all that. So by this, there's a way or there's a chance opportunity for us to enter and to sell this product because you can attract people. They will take photos, take the posts, videos, etc., and then they can come in. Okay, and with that, if you see that you're able to fill in this gap, then probably joint ventures or wholly owned subsidiaries could be the way to go. Okay, second thing, the cost of entry. Exporting contractual mode is more suitable for markets where high entry costs exist as they reduce the upfront investment. Okay, so now this one, the example, this is just one way of saying, right? You have to look at the overall picture to see what are the costs involved. Some countries, let's say like Singapore, they want to attract firms to come in, so they have different regulations in place. They reduce the corporate tax. They want to cut down on the red tape. Red tape means the regulations. That means if I want to set up a company in Singapore as a foreigner, right, probably it'll be easier compared to another country, right, that is more protective, that's more closed. So they wouldn't want foreign firms to set up that easily. They will make you go through all the processes like the licenses, the paperwork, just to set up. So in that case, you have to see whether in that country, is it going to cost you a lot in terms of money, in terms of time, in terms of your resources? So if there is very high entry cost, as they say here, then you may want to choose something that is less commitment or that's going to cost less overall. All right. So if we, for example, they can say that, oh, to set up a new factory here as a foreign firm, you have to pay taxes or to pay levy of 50%. So if you were to buy a factory for $2 million, you need to pay $1 million as a tax to the government. So if such rules exist, then we may want to consider if exporting or franchising is a better option because you can already save that $1 million, right? So there's always this consideration about the cost. Next consideration would be the degree of control, right? Would the firms want to retain control or would they not? Or would they be okay with having less control? Okay, now control here is a very subjective thing. It doesn't mean that if I franchise, I totally let go and just let them do whatever they want, right? And if tomorrow they start selling curry rice at McDonald's, okay, not like that, right? It doesn't mean giving up everything, but it's more like how much can you supervise, how much comes under your watch. If you set up a firm in your own brand, right, you get to control the marketing, the sales, and all that. So the directives, the instructions can be plumbed down to the subsidiary, to the firm itself, to that local firm, and they will have to take the instructions. And there's less room for negotiation because the firm belongs with the main company. But if you franchise, if you do exporting, it is leaving your firm's control and you're passing it on to someone else. That person will have more control because technically they don't belong to your company, they don't work for you. They could be your franchise candidate, or they could be someone that you find to distribute your items, and they will have more say, right? Because that could be how they do things, and they wouldn't need to agree 100% with you on all matters. Okay, so those control, right? If you're able to relinquish, to give up to a high extent, to a large extent, then probably you can go with the uh if you're able to give up, you can go out with the exporting or the licensing, franchising, right? But if you feel that it is not an option, then we could go with the wholly owned subsidiary, right? Because you get to retain the control. Okay. Next point is in terms of your risk tolerance. Are we risk averse, right? Or are we risk tolerant? Okay, so these 2 points here, whether you want to incur more resources, right? Spend more and then not be able to get back. So they say that for risk averse companies, they want to choose things like licensing, franchising, and that would require less resources because technically you're not paying much. So that will reduce your commitment and there's a higher chance that you can break even. For risk tolerant firms, right, if you are able to tolerate the higher risks, then you could actually go for joint ventures or wholly owned subsidiaries. To do with the risk tolerance level, right, another consideration is how much resources you have. Okay, so if you have very high levels of resources, like let's say Apples have tons of cash in the bank account, right, to the point where they can keep doing share repurchase because they just have so much cash, right? They buy back their own shares in the stock market. So if you have so much cash, then it reduces your risk. We could spend $1 million. So risk averse or tolerant, one way to think about it is in terms of your own psychology. Like the owner, are they willing? Do they feel very scared, or are they okay just like not wanting to spend so much or okay spending so much? That is how you feel. Another way to look at risk, right, is how much assets they have. So it could be the same $1 million, right? Company A just set up. $1 million is all they have. So this is 100% of their cash. Company B has been around for 2 decades. They have billions of cash reserves. So spending the same $1 million is just that very small fraction of what they have. So it makes them more risk tolerant, even if the owners feel scared. Because $1 million objectively can buy a lot of things, right? It's a lot of money. But when you have $1 billion, $2 billion, 1 million seems like a small proportion. So you don't feel like, wow, it's so much. But when you only have 1 million and you are spending the whole 1 million, then that's a different thing, right? There's nothing more for you to lose. So by virtue of the fact that you have more or less resources, it could also determine the level of risk tolerance that the company has, right? So if they don't have as much, then even if the owners feel more daring, it may be suitable for them to be more cautious because it could be a win or lose situation. Whereas for the company with more resources, right, even if they lose this, if they don't lose everything, right, they can continue operating. So that can be a consideration for which way to enter the foreign market. The next point is in terms of the risk, right? The cultural, the political, the economic risk, whether you want to share the risk with a local partner. So give me a while, let me try to highlight first. Okay. So the first thing is, what risk are we facing and what types of risks are we looking at? So the risk here could be just country or market specific, right? Like it could be the case where this country has a war, okay, or this country the government is collapsing, right, or this country the economy is shutting down. It's just country specific. It could be also be worldwide, so there is no way that you escape this issue. Like let's say with COVID, right, every country is affected, so it doesn't matter which country you go into. So for country specific risk, you may want to pay more attention because that risk wouldn't be present in other markets. So would other markets be a more viable, more attractive option? Okay, so that's one. Then second thing is, right, for this type of risk, do we want to share the risk with a local partner? So if it's about rules and regulations, you're afraid that you will let's say flout certain rules, right? You go against certain rules and regulations. You may want to find someone, right, who is familiar with the rules. Okay. But if some rules or some risks that you are more familiar with, like economic risk, like let's say the chances of making losses, then you may or may not want to bear with a local partner, because local partner means you have to share profits, right? Or give them some money. So if it's something that you're familiar with, like, okay, every country I go in, there's always a chance that I make losses, then how do I deal with it? So it's a familiar problem, then you may want to actually do it yourself. Okay, again, it's up to the company's discretion. Okay, yes, question.
What about a local partner?
Local partner, yes. What about local partner? Which part?
The cultural and political risk.
Oh, okay, as in what is the involvement of the local partner?
And also, how about overseas partner?
Overseas. Oh yeah, it's overseas. So that means if let's say I'm a Chinese firm, right? I go into Singapore, so I'll be looking at the Singaporean partner. That means they will help me to do things in Singapore. Okay. Okay. So let me answer this. So the partners here referring to the partners in that country, right? Even though they say local. So local is local in that country. Then what is that involvement, right? So if let's say I just let's say okay, let's say if you ask me, okay, let's say I use my own example, So I'm in Singapore. I want to go into, let's say, Saudi Arabia, right? I want to set up okay, let's say Dubai, right? Dubai, economically very strong, but I am not familiar with the culture, right? I don't know what people like. I don't know the rules and regulations of the government. I know nothing. I just feel that Dubai seems lucrative, right, for the products that I sell, okay, whatever I sell. So now I want to minimize my risk of running into a problem. Maybe unintentionally, unknowingly, right? I go in there, I do something, I break the law. So I don't want to risk that. I will find a local partner. So the local partner will be a firm that is already based in Dubai. So they know, okay, what can you do? What can you not do? What customers like? What customers don't like? So they will tell, they will share. And then once I'm familiar with all this, it's like I go through a crash course, right? Instead of trying out myself and then make mistakes, come back again, redo, make mistakes, redo, right? It could spend many years before I finally feel confident operating in Dubai, or I can go with this partner. They teach me everything, right? Within few months, I feel I'm ready. I will go set up. So it cuts short the whole process. It makes it faster, and there's a smaller chance that I'll break the law, right? Like they'll tell you, okay, doing this, right, is against the religion, or doing this is frowned upon. Whereas if I do it in Singapore, maybe it's okay, right? Maybe some way of talking, some way of operating, some way of doing things is okay in Singapore. This is the culture. But doing that in Dubai could be different. So then they will share with me. I will be learning much faster. I don't make the mistakes. I will have more. I'll be able to go into profitability, and everything runs smoothly much faster. So now coming together, we have talked about 1, 2, 3, 4, 5. Okay, so we have 5 factors. The question could ask you to explain some factors. At the end of the question, they could ask you to choose the method. And looking at all these different factors, right, they could have very varying, very contrasting outcomes for you. Okay, for example, let's say the market size. It could be very lucrative. That means I want to do a joint venture, or I want to do a wholly owned subsidiary there, right? Based on factor 1. But let's say now, in terms of the risk tolerance, right? My risk tolerance is very, very low. I don't want to spend so much money. So by that factor, I should go with exporting or licensing or franchising. So you see that factor 1, market size and potential, tells me or advises me to choose wholly owned subsidiary. But factor 2, risk tolerance, tells me to choose something else. So they don't match. Then the next thing to consider is which is a bigger consideration. Okay. So you wouldn't have the case where all the 5 factors, right, will tell you choose this, choose the same thing. Unlikely, right? It's just like when I'm choosing university, for example, and I ask different friends, different family members, they will give different opinion. Some will tell you study in Singapore, some will tell you study overseas, right? Or this will say US, that will say go to Australia, that one will say, oh, just go to Asia because cheaper, right? Everyone has different considerations, everyone tell you different thing. You cannot go to you cannot be studying at 5 universities at the same time, right? You also cannot be not studying university at the same time at all. So you have to choose something. So back to your situation, right? Based on all the different factors, once you have explained the answer, you have to decide which is the biggest factor to use. So it could be that looking at all this, right, because the firm is really, really tight on resources, they cannot afford to be very risk tolerant. So risk tolerance becomes your biggest consideration. We will go with that. We will not go and set up. We will just go with exporting. We will just go with franchising first. Then subsequently, when the conditions, when the financial resources allow, then we can go for joint ventures. Okay, so this is how we can advise the firm. All right, so again, just to sum up, so you have different ways to enter the market, the foreign market. You have different considerations, all these different factors. The factors will not all tell you the same decision. Okay, they will not advise you the same way. You have to decide which is the biggest factor to choose, which is the most important thing. Okay, like if this person really, really has no money, then even though their relatives telling them go US, go Australia, go overseas to study, that person's main concern could be money. So they are limited by the cash, by the finances. They will simply just study in Singapore. It could be that, US gives you more exposure. US gives you more freedom because you are not subjected to your parents' control. Because it's the chance, right, for you to venture overseas, to explore overseas, right, before you come back to Singapore to work and you are tied down to the office. Right? So it could be the last few years for you to just enjoy traveling in US before you have to come back. That's a very valid point, right, to choose a US university. But then again, because the family can't afford, so they can only choose Singapore University. So that is the biggest constraint, then that gives us the direction or the decision we have to make. Okay, so this is how we go about doing everything. So you have to be familiar with all these points for the questions that we do. Okay, so they give the example of Starbucks, right? Initially, they entered China through joint venture using the local partners' expertise. And then as the market matured, they shifted to wholly owned subsidiaries. So this both here is under the investment mode, investment entry mode. And even within that, right, you have the two ways of joint venture or wholly owned subsidiary. Joint ventures, essentially, you are partnering up with someone else, right? Wholly owned means you do it everything yourself, no other partners. So Starbucks took the more conservative way. They chose a partner first. Then after that, they did without the partner. So that was when they already have the local knowledge. They had the experience of operating in China already. So that is the context, the example of Starbucks. All right. So let's look at some of these questions and answers for our recap. So first one, explain the advantages and disadvantages of different export modes for countries entering international markets. This one essentially is just a warm-up, okay? So there's only one part. It is an essay question, and with the only command word is to explain. All right, let me bring back here this part. Okay, so for essay, they are worth 20 marks each. Okay, bear this in mind. So the marks will be indicated in the paper, in the exam, right? But for now, just to remind, it's 20 marks each. So for this question, we need to be very aware that it is for 20 marks. You cannot be writing 2-3 points and then finish. Okay, so it has to be more detailed because they're only asking for one thing, right? The advantages and disadvantages of different export modes. So we have to give more details. So the first portion, the intro, we can mention the various entry methods. You can do exporting, you can do licensing, franchising, wholly owned subsidiaries, you can do joint ventures, right? They just need that. So for example, for exporting, right, they explain what it is briefly. They gave the two ways, direct, indirect, and we talk about the advantages and the disadvantages. Things like maintaining more control, eliminating intermediaries. Then disadvantages, they talk about more resources and then navigating all these foreign regulations, etc., could be very difficult. Now, just to note, here it's presented in point form, okay, and to make it more comprehensive, right, more points were included. For the exam itself, please explain in more detail. Okay, so you have to mention like, okay, what do we mean by maintaining more control? Can you give an example? Can you explain further with more details? All right. Please don't just write this 1 point, 1 point, 1 point. We don't want many points. Okay. We want to have more explanation. You can have fewer points. Advantages, you can give one, you can give two. Then disadvantage, you can give one or two, right? If you decide that you don't want to split between direct and indirect, you can simply just talk about exporting as a method by itself. So that means exporting as a whole. It doesn't have to be direct, indirect exporting. So you can structure that way as well. All right, this is just one option. And second of all, this one, we can actually add on. Okay, again, right, we look at this question, the intention is not just for us to read and then finish. Okay, it's also for you to think whether the question is complete or the answer is complete. Okay, so it's 20 marks worth. You can write more, right? You can write more. Oh, okay, let me see. Okay, let me change. Okay, this one was a bit different entry modes. Okay, this one was typo. No wonder. Okay, yeah. Okay, so with that, then we want to actually add on more points. So for example, here, right, you can talk about joint ventures. You can talk about wholly owned subsidiaries, or you can talk about it as investment entry mode in general. Okay, so how you structure is a bit flexible because we talk about that main method, right? Export, you have direct, indirect. Then investment, you have like JV, WOS, right? Joint venture, wholly owned subsidiary. So if you want to consider them as one big umbrella term, right? Let's say investment mode, then you can. So you will give the examples of joint ventures and wholly owned. Then in terms of advantages and disadvantages, you will talk about investment mode in general. But if you want to branch out, if you want to be more specific, joint venture can be one method by itself. Wholly owned can be another method. That means you split this into two methods. So both are viable options. Okay, then the last part here, you can do like licensing. You can do like the franchising. So for this whole answer, give at least three ways, three methods, and then provide the pros and cons. That is if we explain and expand the points fully. However, if we are just giving very brief points, or let's say in this case, they only do the point form, then you can actually give more methods. Okay, but I wouldn't suggest you do point form. Please don't do point form. Point form only if you run out of time. That being said, you shouldn't have point form throughout your answers. Okay, or for all the whole paper. All right, the majority should be written in full sentences with fully developed points. Then maybe for the last few questions that you do, then we would give in point form, because by then maybe you run out of time. You don't want to leave blank, then you can just type some random points. Okay, but please don't do point form throughout. Okay, otherwise it may not score well. Okay, so these are some other options. You add in the pros and cons, and that will make the answer complete. Okay, let's move on. Analyze the role of contractual entry modes in international business. Provide real-life examples to support your analysis. All right. So for this, we are supposed to provide real-world examples. This alone will give us some marks. Okay, so if you really cannot explain anything, but you do recall some real-life examples to use, then feel free to use them. All right, to get some marks at least. Okay, so contractual modes, we talked about licensing and franchising, right? They are asking about the role here. Okay, later we'll delve into that. So first thing, of course, you have to explain what they do, right? So this is what licensing does. It gives the foreign company the rights to produce and sell products under the licensor's brand in exchange for royalties. They gave the example. Advantages, disadvantages. Franchising do the same thing. What is it about? Example, and then advantages, disadvantages. Okay, so for this, because they say to analyze the role, apart from giving the pros and cons, okay, you may also want to look at whether this is a very suitable method whether it is a commonly used method. Essentially, the question is asking you the function, the role of this way of entering foreign market. So is it an important role? Is it a commonly practiced method, or is it something that we hardly use? So if it's a very important role, an important way of entering, then we have to explain why. So it's not enough just to explain about pros and cons. You have to also mention the relative importance, right? I mentioned the relative importance of this way of entering that market. So also include, right, the relative importance of using this entry mode to enter foreign markets in contrast to other entry modes. All right, so that is more towards the end, your evaluation, your opinions. Okay, like giving some thought, right? Okay, how do we feel about this method? Is it easy? Is it commonly used? Is it fast free? Is it costly? Is it fast? Right? So all these could be your considerations. And we make use of this to look at the role of this contractual entry mode. Okay, right? This one just to add on. Then question 3 here. Explain the strategic factors that companies should consider when selecting an entry mode for international markets. Okay, again, straightforward, right? Explain the strategic factors. So for this, you may want to explain as completely as possible. That means you can give all the 5 factors, and at the same time, please do include your real life example. Okay, so for these easier questions, right, again, the competition level will be higher, right? Because if the question is easy, then everyone can do, right? So you want to have an advantage, have an edge over your friends, then please include something further, like give an example for this question. Okay, so you can give example like here they talk about companies like Amazon. We talked about things like Starbucks, right? Companies. We talked about Toyota. Then all these are very ample examples. And in fact, you can actually develop further, right? So here is just giving a one-liner, two-liner kind of answer. You may want to explain more fully. Okay, you may want to explain more fully. Like for instance, if we talk about market size and also the growth entry, the growth potential, we want to talk about how they measure market size, right? How do you evaluate if the market size is big enough for you to enter? That's one, right? What are the different metrics? Then you can also give the example of companies that chose to set up in a certain country, a certain market, instead of just exporting. Or are there examples of companies that were exporting or were doing franchising, but later on decided to do wholly owned subsidiary themselves? Write all this, not just one line, two lines. All right, you can develop more fully, okay? Because this one will be awarding 20 marks for the question, right? So you shouldn't be just writing a few lines. Then again, same thing for like cost of entry, right? This one doesn't have to be talking about just tariffs. It can be like the overall cost, right? In terms of hiring the local workers, taxes to pay, going through the different the whole loop just to set up there, etc. All these are the costs involved. Cost can be in terms of money, time, resources, manpower, energy, right? So all these are costs to a company because there's always, even if you're not spending money, right, there is always this thing called the opportunity cost. Opportunity cost, that means whatever I do, right, no matter what the resource is, once I use it, I cannot use it for something else. It's like if I spend 3 hours exercising, I wouldn't be able to spend the same 3 hours studying for exam. Or if I go shopping, right, for 2 hours, I wouldn't be able to spend the same 2 hours to meet up with my, okay, the one you can do together. But let's say the same 2 hours to exercise. So there is always this give and take, right? That means you give up something, but you are taking up something. Okay, so in that sense, right, even if the firm is not spending a lot of money, it could actually be incurring a lot of time. It could have to navigate all these difficult paperwork, getting the licenses, etc. It will take forever, right? All the time spent, all the energy spent, they could actually do something else that could give them more revenue. So with that, you may want to factor in whether, right, this is going to affect your choice of the entry mode. Okay, Then same thing for the rest. Now for this paragraph, when you see just explanation, right, you don't really need to provide any conclusion. Okay, so at the end of the answer, if you feel like, okay, these are my points, 5 points, I've explained fully already, then that's the end. There's no need to say in conclusion, blah, 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 right? In conclusion, and the conclusion paragraph is only relevant and important when we are doing discussion essays. So like second question here, analyze the role of the contractual entry modes. So this is asking for your own opinion. They need your own ideas. They need your own input. Then you can actually you need your own opinion. So that will need the overall, in conclusion, blah, 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 at the end. That is where you provide your own opinions. But for other questions, right, where they only ask you to explain something, right, they only ask you to explain something, then there is no need to give the paragraph, the final concluding paragraph. Okay, because you only need to give your points, right? There's no need for your own opinions. Okay, so the difference is as such. All right, hopefully you guys are familiar with the requirements of the questions by now. Huh? Explanation, there is no need for opinion paragraph. You can just give the points and finish. If the question asks you to discuss something, analyze something, then you need to provide your own opinion at the back. So you will need that one paragraph. In conclusion, feel that, I think that, right? Or I have the opinion that, blah, blah, blah. Okay, so these are the different requirements for the different question types. Okay, so along the way, as we go through more questions here, right, for revision, then as we're already doing, then you can actually refer and see whether we need or don't need certain parts, right? Or how do we navigate the whole question. Okay, so these are some of the requirements here. Okay, so just to sum up again, today's topic is on the entry modes, right? How the company can enter into a foreign market. So we looked at exporting, we looked at getting a license or the franchise agreement. We looked at also having the joint venture, also the wholly owned subsidiary. Okay, so these are like some of the main methods, right? There could be other ways that we have, but we keep the context to just these few so that it's easier